Hi, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. We're recording this on Thursday, December 4th, and I'm delighted to be joined by David Miller of Conficap. He's based in Finland now, but we have known each other for years on the circuit. He's been a frequent commentator through his many newsletters, which he has described in a podcast with me as going to the mental gym. So I've been very happy to see that despite his move to Finland, he continues to go to the mental gym and share his Northern Lights newsletter with us. So welcome, David. Thank you so much for joining me here.
Thank you.
Well, let me bring up the slides. I call this podcast Code Red and Red Alerts. And it's appropriate. We've got Christmas on our mind. We've now turned into the Advent calendar in December. The Code Red refers to Sam Altman's perhaps prophetic calling of a Code Red on OpenAI, in basically the belief that perhaps ChatGPT was being encroached upon by Google and Gemini 3, and they seem to be downing tools with some of their other innovations in order to focus just on the model. So that may be a siren call for trouble in the paradise of AI and all things related to it. So let's see about that. And then, of course, we are Red Alerts. Christmas is coming. We're speaking to somebody in the land of Santa Claus. So that's that connection there. As usual, we cycle through inflation, interest rates, equity markets, geopolitics, and other asset classes. We will have a little to say about gold today. And some of the sub-conversations we'll be touching on speak about our economic vibe check. Seems to be somewhat neutral, although we'll see if David agrees with that. We'll speak about bonds and how they're behaving and whether it's as we would expect, given some of the economic indicators. We'll talk about equities doing a bit of a round trip in the past week, certainly, and this was also the case in November. We're going to look at some other asset classes, the soaring price of copper. We'll touch on India as perhaps a cautionary tale, or maybe not, when it comes to emerging markets. And as always, we will refer back to portfolio implications for all of these asset class changes. So here's David. He's investment director of Conficap, based in Finland. As I mentioned, he was a fund manager for many years, previously at Quilter Cheviot. And his monthly newsletters, whether they're monthly or weekly, are never something to miss. Always insights and some great take on current affairs. So I'll let you read about David there. When it comes to inflation, so the first point about inflation is clearly we are taking a little bit of the rough with the smooth here. We've spoken about the K-shaped economy, and we've spoken about how the lower end consumer seems to be struggling with affordability, as well as in terms of sentiment. And just two things to take. There haven't been that many high-level inflation numbers at the moment, but we do have some info on wage rises. And I think as we would expect in a K-shaped recovery, we're seeing wage rises for the highest paid running ahead of those for the lowest pay. This is probably going to spark more concern about the effect of AI on wages and displacement of the lower earning worker. And equally, another chart here shows that lower income households after tax wage growth had dropped back to 1% year on year, while higher income households wage growth eased to 3.7% year on year. So still quite a dramatic difference and delta there between the higher earners and the lower earners. And I think it's appropriate that we're speaking with David based in Finland, which is known as having perhaps a higher tax rate and perhaps less inequality. I'd love to, can you comment on inflation, affordability as you see it from your vantage point? Any perspective you wish, and maybe some about this dispersion. Does this concern you? This is a US chart, but what do you see from your vantage point?
Well, I think this affordability issue is common all around the world. It is a problem. The inflation of a few years ago hasn't led to any price falls, and so things are just more expensive than they were. And the lower earners spend more of their money on the basics, and that is where the pain is being felt. So from Finland's perspective, we have low inflation here, but a rather dull economy for the moment, and that's a challenge. What I would say about the taxation, though, is that it is on the high side. I haven't moved here as a tax haven, but it certainly feels much less of a psychodrama than's been going on in the UK over the last month or so. So I think touching on what will happen with inflation and what impact that will have, I think that I'm very interested in how things go in the US. I think what will be done ahead of the midterm elections next November. And I suppose the simplest thing to say is that I would expect there to be a fair amount of helicopter money showered on consumers to make them feel happier. It's a political game, and it will have an impact, I think, on that end of the consumer market.
I think you make an important point there. I mean, prices are not coming down. This is still inflation. Prices are still rising, albeit at a lower rate. So any narrative that has prices falling is probably a false one. And I think we do have to keep an eye on this lower end consumer, particularly in the US, as that may influence their voting tendency. But equally, it's going to stoke, I think, some of this sense of inequality, which we know has been behind some of the populism that we've seen. So very interesting to bring in Finland there. And then when we're now moving on to interest rates, which is the natural kind of a follow-on from a discussion of inflation, it seems that we are firmly, especially with some jobs numbers even today, looking weaker in the US. It seems that the major consensus now is behind a further cut in December, and certainly a Fed chair, most likely Kevin Hassett, who is firmly behind an aggressive set of rate cuts. This chart is one I showed last week, which shows the comparison between the resting plateau interest rates around the ECB, Fed funds, and Bank of England. And the interesting point is that whereas the ECB is the lowest of the three, we have the Bank of England coming in a little higher than the Fed funds. From your perspective within the Eurozone, can you give us a sense that what has been the ECB's, I suppose, play here, given they don't have high inflation, as you mentioned, they don't have a lot of growth, and they've been fairly committed to lowering rates. Do you think that that's a confident strategy, given where the chance of overheating may be low?
I think the chance of overheating is lower than in the US. But the ECB is being very cautious about this, and the market is telling us now that we're down at the low level, that we're not expecting a further cut next year, which makes it very different to the US, where we are expecting a further cut in interest rates from this level. So I see the differential between the two areas at the short end narrowing in the year ahead. Long end's a different matter. That's up to the market.
And you used to be a fixed income portfolio manager, if I recall correctly, or at least that was a part of your remit. What are your thoughts currently on what's going on in bond markets? So we've had this situation where the premium gap in UK yields has widened under the current administration, even higher than during the kind of catastrophic gilts crisis during Liz Truss's short-lived premiership. We also have UK 30-year yields significantly higher than France, Germany, and the US, and a sense that maybe this is a new normal. Or what is your take, having looked at fixed income markets for many decades, in terms of where we are, maybe a kind of a pulse check on fixed income markets today?
Well, just to defend myself, I have never been a fixed income manager only. I've always invested in fixed income markets within a broader portfolio. And I would say the difference between people like me and the experts is that they get optimistic and they go long duration by half a year, or pessimistic and they're short duration by half a year. Whereas I might do stupid things like being long duration by 5 years. I think I always saw fixed income as a source of added value, as opposed to something just as a risk-off area of the portfolio. So that's just to put that in perspective. But you're absolutely right. This is a very strange market. All the way through my working career, the US Treasury market has been the risk-off safe haven. And it just isn't anymore. Nobody can rely on the US Treasury market as being a risk-off investment. It might be a good investment, but it's not the risk-off one. That's strange, number one. Strange, number two, is the fact that now we can actually earn a real return out of JGBs in Japan. And that hasn't been seen for a long time. So we've got some funny things going on. And as you point out, there are many bond markets around the world now, government bond markets, which yield less than the US. And again, that's an odd situation for fixed income managers to find themselves in. And I think my approach to it is that I revert to my usual approach, which is, can I add value in fixed income, as opposed to can I hide when I'm not feeling very happy? I just think that's a very different issue.
Really interesting. And I think that the issue of hiding, this would also suggest that at these yields and at inflation subdued, but not quite where it used to be in terms of a target, cash still presents a reasonable place to stay, which is interesting given we see so much in money market funds. So in a way, portfolio construction is a little bit, I suppose, tilted by this, because it does make sense to stay in cash a little bit longer, as long as inflation stays under control, as long as interest rates stay where they are. But equally, as you said, may be more volatile, less of a risk-off asset. But on the other hand, we see also that volatility has been quite low in fixed income. The MOVE index has been way down and below the equity index, but certainly it has been low. So it's been interesting to see, I think, just how that has transpired. Moving on to equity markets. So we've had a bit of post-holiday indigestion in the US, a bit more of this sideways movement. The NASDAQ is still outperforming, but just in terms of the narrative that has emerged, we emerged from a November which did surprise markets by ending more or less flat. However, we have just definitely had, I suppose, sporadic interruptions of the positive momentum with concerns around a bubble. As I mentioned at the beginning, OpenAI declaring a code red certainly doesn't do much to stem talk of that. On the other hand, earnings have remained very strong. These are percentages showing earnings beat. So remember, these are expectations that are well telegraphed and well managed. And then the sectors go on to actually beat notwithstanding. And if we see the percentage of sectors that have, certainly the percentage within a sector that has beaten earnings, we have healthcare at the top, 93% beating earnings, and communication services at the bottom, 52% beating earnings. So when you have the majority of these stocks beating earnings that are already fairly well massaged, this is without doubt, I suppose, a sign of health within the sector for now. Perhaps a sign that tariffs have not worked their way through. But it is, I would say two things jump out of this chart. One is the overwhelming strength of the earnings numbers, and two is that healthcare has plummeted, so I suppose has parachuted to the top there, which could be a strong indicator for that sector, which could suggest we get more breadth into equity markets, which have been dominated by this concentration. Given your European vantage point, how do you think about the US market, its relative health, and how Europe is comparing in comparison, David?
Well, nothing about what you against you by mentioning the word bubble, but I find that many people say bubble and then they immediately disengage brain and stop thinking about what it really means. And we are in a rise, have been in a rising market. We've been in a market, particularly in the US, of great enthusiasm about a small number of stocks in a small number of sectors. And that's absolutely fine. I mean, that is how the world goes. But you're right to highlight earnings. And as an investor, the issue is what's not to like about a time when we're actually expecting corporate US, and you mentioned the US in particular, but it works elsewhere in the world. The corporate world is going to be producing better earnings next year than this year. And this year was perfectly respectable. And as we talked about a few minutes ago, interest rates in the US, if we get lower rates, investors like cheap money. And they like cheap money with corporate earnings growth. And that's a very satisfactory background against which to make investments. And therefore, running away from risk because of the bubble talk, I think is a mistake.
Really interesting analysis there. And I think I'm just going to flip back to one of my previous charts about the effect of inflation on wages. And I think what I would get to is the underside of this earnings picture is always, well, how are they getting to those earnings? What are they cutting? How are they preserving margins? And how are they getting rewarded for having some very high profile, perhaps cost control? And often cost control, the first place to go is to one of the more flexible parts of the variable cost, which could be labor. So this could well be a backward looking indicator of just how much cuts have been made on the labor front. And this may manifest later on in consumer pain, which could ultimately, in the circular way, affect some of these revenue numbers, which will ultimately trickle down into earnings. So I suppose it's not necessarily this Wall Street triumph is not always a Main Street triumph. And there could well be maybe kind of an underside to this jubilation. I'd also heard another point of view, which was around valuations, which is suggesting that are we even looking, is earnings even the right indicator any longer? That we have a lot of speculative assets now entering the fray, such as Bitcoin, digital assets. And equally, we have so much in the AI that is forecast and in the projected future, which is difficult to foresee. Do you have any thoughts? Have you digressed from any of the traditional valuation indicators as you look at markets today?
Absolutely. I think you have to, because I think that the future is going to be very different to the present and the recent past. I mean, you can't have the sort of the assault on the global trading system which is coming out of the US. And you can't have the implications of developing artificial intelligence without expecting there to be quite a few changes. And I think that if I was going to pick up, I talk to pessimists very regularly as well as optimists, but the pessimists are worried about the labour market. It doesn't look particularly healthy, and that would have a knock-on effect through the economy as we go through next year, and that is definitely something to keep an eye on. But in terms of looking elsewhere, you mentioned Bitcoin, crypto, and the like. There is speculative investment in some of these areas on margin, and I think what we're seeing at the moment is an evaporation of value created by the fact that an asset that falls, which has been bought on with borrowed money, you tend to find you get margin calls, which means you have to sell. And it's self-feeding, and this is what we're seeing at the moment. So again, part of the normal cycle of enthusiasm and pessimism, which we've seen before and we will see again. It's all down to human nature. But I'm interested in other assets. And again, in this period, there are some that are performing a lot better than might have been expected. And they should be part of a portfolio, a well-constructed portfolio. And I think one has to be imaginative about looking elsewhere than simply bonds and equities.
Well, I can't wait to talk about those other assets. But just before we leave equities, I'd love to tap into your vantage point sitting there in Northern Europe. I'm a huge fan of Nordic noir, and some of the somewhat the kind of jaundiced views sometimes on events and world events that can sometimes come out of that part of the world. And I think just the skepticism perhaps, and I love the insights. What is the view around US exceptionalism, around allocation to a global portfolio, how much should be in the US? And what is perhaps the view on Europe as an allocator?
That's a multifaceted question. I'm trying to remember all parts of it. I think the Nordic view, let's put it in perspective. So I'm in Helsinki. I'm at the same latitude as the Shetland Islands, and I'm at the southern end of the country. So up north, when you ask somebody what time does the sun rise, they say 17th of January. So this is a very different world. Think Alaska, if you want to look in North American terms, way north of Calgary. So we have a different perspective, and I think there is growing confidence that the Nordic region is socially coherent, well governed, well managed, and we think we can take advantage of what's going on around the world. So I would encourage everyone to look carefully at what is going on here up north, because it is different to other parts of Europe, and it's definitely different to the US. We're not like Asia in any way. We could talk about that as well if you like. So Finland is a small country, small economy, 5.6 million people. We've always had to look out, always looked out. And so there is a heavy commitment to investment in other parts of the world, including the US. And there has been concern over the last year about the weakness of the dollar, to hedge or not to hedge. But there's been relatively little concern or action around weightings in the US. So essentially, I would say, speaking generally for Finnish investors, we're committed to the US and we haven't really done much about selling it.
Well, that's a great answer to a long question. Thank you very much. And I think just in the interest of getting to the nub of the subjects that you have some great insights on in particular, let's talk about Asia briefly. I have some slides here about India. There was a recent article in the New York Financial Times about India, suggesting that it had really been disappointing on the equity front this year. We've seen the bottom chart showing earnings forecasts being cut. That contrasts quite dramatically with that other earnings chart I showed around the US. We have a chart here showing the Reserve Bank of India keeping its rates high despite India's inflation falling sharply. And this may well be a cautionary tale, given that that's been the attack on some other central banks, that they have been too slow to start cutting rates, even as inflation is falling. I wouldn't say it's falling sharply in the West, but it has certainly been falling. And whether is the cautionary tale that keeping rates too high essentially has a knock-on effect on growth and the economy's ability to thrive. So you mentioned then Northern Europe being quite different from Asia, but I know you have some interesting perspective on India in particular. Can you tell us a bit about whether you share this Financial Times view?
Absolutely not. The Western media, and I won't be specific about the FT, but the Western media has been notoriously bearish, critical about India for decades. All right, so this is not a new story. They're simply attaching that old story to what is going on at the moment. So I don't much like it. I'm an investor in India, in actively managed funds that focus on smaller companies, and it's a great stock market. It is a proper stock market, a proper economy. It has positive interest rates. It has a government that, generally speaking, has a plan, a long-term plan, which is raising the population out of poverty, and it's been implemented very, very professionally for a number of years. And when you go to India, I would describe it as you can warm your hands in front of the fire of entrepreneurial enthusiasm. People want to do things there, and it has a big effect. So I like it because it is a domestic economy. It's well over 1 billion people. They're all young, and they're creating wealth and creating some really interesting companies. And that's what I want to invest in. Now, the fact that interest rates or monetary policy might not be quite conventional doesn't really matter because it's fairly self-contained. And I think it was really interesting that when President Trump arbitrarily imposed a huge tariff on India, apart from it, that wasn't very helpful in the short term. It's actually had no effect on this. So I would regard from a dollar perspective or a euro perspective, the currency weakness in India is an added reason to look very carefully at adding or buying into this in 2026, because I think you're going to find that the variety of opportunities there is very wide and is not really reflected in an index focused on a few large companies that some people will have heard of. I think you need to do a lot more work when you go there, but it's worthwhile.
That's a fascinating insight. And I think I'm going to pick up on something you said about it was placed under strain and it had no effect. Because I think what we tend to do when you mention some of the laziness with bubbles and here and there and attributing causation in retrospect, and what we often don't do is we find negative causation or no causation. And that's one previous guest spoke about some of the strains that private credit have been under time and time again. The tests on the fact that it had not buckled was actually a sign that market was strong. And I think it's interesting to look, we need to almost track these threats that never come to pass, because it does perhaps tell us more about the complexion of those economies than we would otherwise see. And I do want to jump onto your other assets discussion. So I'm going to very quickly just touch on a few other commentaries that I've seen throughout the week. So this was a couple of charts about the rise of non-bank financial institutions. That was, I think, was quite a telling sign of just the growth of private credit. We've spoken about it rising to over 3 trillion. But we know that the diversified banks have performed well, certainly versus some of the private credit BDCs recently. But I won't touch on that in detail on this. We've talked about active, passive, US exceptionalism, and the rise of copper, which kind of brings us a little bit into our discussion around other asset classes. Copper is rising as demand rises. We know Chile is one of the largest copper producers, and how exposed that is to this current level of demand. In other news, we've seen that a headline I thought I would never see around the City of London risk running out of supply of top office space. That seems to be almost a return to the narrative around that we saw probably last time, definitely pre-COVID, around the demand for premium office. And clearly return to the office is back in full swing. And maybe we haven't caught up yet with a change in that particular real estate narrative. And then just on the geopolitical, on the deal making side, we've seen that deal making seems to have recovered and is coming into a great year. So that brings me to my last point around other assets. And I appreciate that was quite a whistle-stop tour of some other news items. So we've been talking a lot, David, in this podcast about the rise of gold, about the kind of, I suppose, the choppy path that Bitcoin has wrought, and about demonstrating that it really hasn't been digital gold in any respect. It has been quite different. And this chart at the end really shows the difference in performance between silver, again, less talked about than gold, but hitting an all-time high, and gold performing very well and sustaining up there. Bitcoin having a very rocky past few months, despite a sort of a U-shaped recovery in the past week. So I'd love you to talk about your thoughts on some of those other assets that could form part of a portfolio besides the traditional ones we mentioned at the beginning, and that will be how we close out.
Well, thank you for that opportunity. So no Bitcoin in my portfolio. Wasn't I stupid? Aren't I clever? Then I think the sort of complications of gold, silver. Let's keep it down to the simple things that we can talk about in a short period of time. But I think that gold has been performing well, and has performed well for a very clear reason. I started my career in 1980, just as the previous gold peak happened. So I saw the damage done after that. And I wasn't really involved in the market for a long time. I think what changed my mind was really that when Russia invaded the Ukraine, and the Russian dollar reserves and US treasuries were frozen, that any sensible manager of central bank reserves around the world would have thought, is it possible that we could be next? And I think that has been the huge tailwind behind the rise in gold prices over the last 3 years now. I think on top of that has been, as we talked about earlier, some concern about the reserve status in the US and its security as a safe haven, and then the arbitrary tariffs on different countries who thought they were friends of the US. So overall, I think there's been a lot of central bank buying of gold, and it's driving the price higher. The speculators aren't really in it a lot. I mean, they come in, they go out. But what's really interesting is that this has been driven by price insensitive big institutions, and they seem to want to keep buying it. So I've got some gold in our portfolio. Would I buy more? Not sure. Am I selling? Absolutely not.
And in our last minute, can you tell us about some of those other asset classes that you think are worth a look and that belong in a portfolio?
Well, I've got a broad range. So we've talked about my favorites. I think Japan is going to be an interesting market to be in the year ahead. I think there's a lot going right for Japan, and has been for some time. As someone said to me, hasn't it gone too far? And then he said, well, I'll give you the answer. It's been a 35-year bear market followed by 3 years of rising prices. I think it might last a bit longer. And I rather subscribe to that. Political change, good companies, what's not to like?
Well, that was wonderful, David. Thank you so much. I think I will rename this particular podcast "Going to the Mental Gym with David Miller," because that's what you've allowed us to do. And thank you so much for continuing to always inject stimulating and slightly lateral thinking commentary into our dialogue, because that's very welcome to have such a fresh perspective. I'd argue that it's getting even more fresh and more unique. And the more north you get, and perhaps getting out of the fray allows for that kind of even more big picture perspective. So thank you for coming here, sharing your insights with us. And thank you everyone for listening to the Markets Happy Hour podcast.